Thank you so much for joining us today, and welcome to our first Bremer Bank Webinar. Introduce Julie Whitney and Brent Martzfeld, who will equip you with knowledge of navigating this unique economic environment. So let's meet Julie and Brent. Julie is a commercial banking manager based in Fargo, North Dakota, with over 3 decades of expertise in accounting, finance, and commercial banking. Julie brings a wealth of knowledge to the table. Her journey began in public accounting, where she discovered a passion for supporting businesses and led to a successful career in banking and finance. Throughout her career, Julie has worked closely with commercial and industrial businesses, guiding them through business life cycles and navigating unprecedented economic challenges. Welcome, Julie. And Brent Martzfeld, a seasoned treasury management consultant with over 15 years of industry experience, joining Bremer in January of 2024. He specializes in working with middle market clients throughout the state of Minnesota. Brent has developed expertise in optimizing cash management, streamlining financial processes, and implementing effective treasury strategies. His extensive knowledge and consultative approach have earned him a reputation in the industry as a trusted advisor. Brent's passion for driving financial efficiency and improving businesses' processes have made him an invaluable asset to his client and the Bremer banking team. Please join me in having Julie and Brent join us today, and I'll turn it over to Julie.
Thank you, Jim. So first, let's talk about what working capital is. Working capital is a financial metric that represents the difference between a company's current assets and its current liabilities. It's used to measure a company's short-term liquidity and its ability to cover short-term obligations. Maintaining an appropriate level of working capital is important to ensure the financial health of your organization. So what's impacting your working capital? Let's take a moment to examine the current factors that are impacting working capital. Over the past few years, companies worldwide have faced numerous challenges. Adverse events can arise unexpectedly from various sources, such as severe weather and geopolitical conflicts. Many of you have likely been impacted by supply chain disruptions, labor shortages, and the effects of 40-year high inflation. Inflation is being addressed through increased interest rates, as Josh explained. That raises the cost of capital for businesses. Higher costs compress your margins and cash flows, presenting new challenges, particularly in managing working capital. So why does this all matter? Efficient working capital management ensures that a company has sufficient cash flow to meet its short-term obligations. Liquidity is crucial for maintaining smooth operations and avoiding financial distress. By optimizing the use of current assets and liabilities, companies can reduce the need for external financing. This leads to lower interest expenses and higher profitability. Timely payments to suppliers can strengthen relationships and may lead to better terms, such as discounts or extended credit periods. And this can further improve cash flow and reduce costs. Efficient management of inventory, receivables, and payables streamlines operations. This reduces the cash conversion cycle, allowing your business to operate more smoothly and respond quickly to market demands. Effective working capital management provides a buffer against economic fluctuations and unexpected challenges. This stability helps maintain investor confidence and ensures long-term sustainability. Strong working capital management improves a company's credit profile, making it easier to secure financing at favorable terms. This can provide additional resources for growth and investment. With efficient working capital, a company has the financial flexibility to pursue new opportunities, like expanding operations, launching new products, or entering new markets. Efficient use of working capital can reduce the need for costly short-term loans or credit lines. This cost-saving measure directly impacts the bottom line, enhancing overall financial performance. Finally, companies that manage their working capital efficiently can operate more effectively and respond faster to market changes. This agility can provide a competitive edge in the marketplace. So, what's your cost of capital? The value of working capital is unique to each business, and this uniqueness is influenced by the business's cost of capital. Cost of capital is the rate of return that a business needs to earn on its investments to maintain its market value and attract funds. Understanding your cost of capital is crucial for making informed financial decisions. It's typically calculated using the weighted average cost of capital, or WACC. It includes the cost of debt and the cost of equity. A higher cost of capital means the business needs to generate higher returns to justify its investments. The higher an entity's cost of capital, the more value there is in converting accounts receivable, or AR, into cash. When funds are tied up in AR, they're not available for other profitable uses, such as investing in growth or paying down debt. So let's take a closer look at accounts receivable. Starting with days sales outstanding, or DSO. That measures the average time it takes your organization to collect its accounts receivable. To better understand where there might be room for improvement, benchmark your metric against your historical performance and against standards for your industry. Do you know what impacts your number? What can you do to improve it? Managing accounts receivable is critical for ensuring financial stability of a business. Set clear credit policies, communicate them to your customers, and establish a culture in your organization that appropriately understands the value of your working capital and enforces your policies. This includes basics such as accurate invoicing and careful monitoring of your AR aging, including engaging in early and regular outreach to collect your receivables on time. Additionally, examine the terms you offer your customers. What negotiating leverage do you have? Can you require shorter payment terms? Is there value in offering early pay discounts? Understanding and quantifying your organization's cost of capital can help you understand when it makes sense to offer early pay incentives. As noted, that value is unique to every organization. Improving your DSO requires a team effort. At Bremer, we consider ourselves part of your team. Brent, our treasury management expert, will discuss how Bremer can assist with receivables.
Thanks, Julie. So let's explore some strategies for augmenting your working capital and receivables. One of the most common issues we hear about is increased mail delivery times, which can slow down payments, sometimes dramatically. Looking for opportunities to accept electronic payments and bypass the post office. Next, expedite your internal processing. Once a payment is deposited, your next steps are cash applications and updating your receivables system. Ask yourself these questions about your process. How long does that take? Do you have all the information you need? How many times are these items being handled and by how many individuals? Finally, evaluate how are you collecting on late payments. Do you utilize credit card processing or ACH for collections to help speed things up? Now that you have identified strategies to consider, let's look at some of the bank tools that can assist you in these processes. To the right, you'll see all the ways that your customers may pay you. Integrated Receivables, or IR, consolidates all those channels into one hub. Money is deposited directly into your bank account. Information is provided to you that you can utilize for updating your system and applying the payments. You enjoy an accelerated cash flow because funds are in your account faster. Hopefully, you'll also see improved employee productivity as employees are not opening envelopes and preparing deposits, trying to match payments to remittance emails. Finally, you get improved visibility. The quicker you can update your receivable records, the more accurate your information is, and the quicker you can spot trends. Next, let's take a look at these tools individually. Positioned around the IR hub are the tools that you can choose. Some clients will use just one, while some utilize multiple. Your industry and whether your organization is business to business or business to consumer may play a major role in this. With a paper lockbox, which have been around for years, checks come into a centralized PO box and are deposited directly into your account. This solution has seen a resurgence in the past few years due to staffing challenges, hybrid work environments, and the slow in mail times. E-Lockbox is for electronic payments. This is where ACH deposits, including payments from bill pay systems, are brought together and posted to your account. Information is then streamlined into a consolidated report. Remittance matching, or payment reconciliation, takes all the incoming ACH payments and matches them to the incoming emails to create a posting file. With AR matching, you provide the receivables data, or what you are expecting to get paid, and we take incoming payment information and match it. An online biller payment portal allows your customers to pay their bills via the web. This tool is most common with consumer payments, but it can also be used for business-to-business payments. Let's take a look at a recent customer that implemented these services. This was a middle market manufacturing company in Minnesota, and we took a phased approach to this type of implementation. Oftentimes, it can be a larger implementation or a lot to process for our clients. This specific client chose to implement the e-lockbox or ACH payments as phase 1. Phase 2 was an actual paper lockbox in the customer decisioning portal. This resulted in a more efficient and streamlined implementation experience for the client. With implementing these services, they were able to achieve one full day of improvement on their DSO, resulting in a $300,000 working capital impact.
Thank you, Brent. That's fantastic. What a great story. So now let's take a look at the impact of accounts payable on your working capital. Just like accounts receivable, accounts payable have an important metric to measure, days payable outstanding, which is the number of days on average it takes for you to pay your vendors and suppliers. Again, it's important to benchmark that figure against not only your historical data, but also against your industry averages. The same and similar questions apply. Do you understand what's causing that number to increase or decrease? Other questions to ask: are you cutting checks or sending ACH payments? Is the vendor pulling payments? Are you paying by credit card, or what other forms of payment are you utilizing? You need to understand your leverage and negotiating position with your suppliers and vendors. Your goal is to stretch your payments as much as possible without harming your reputation. Brent, I'll bet you have some ideas for our guests.
Sure do, Julie. So what strategies can you put in place today? As Julie mentioned, you want to maximize the length of the payments without harming relationships. Hang on to your cash as long as possible. Negotiate with vendors. Interest rates may change their preferences. If you're paying by check or ACH, will they allow you 30-day terms instead of 10? If not, will they accept a card payment for an early pay or give you a discount for an early pay with an ACH transaction? Are they looking at improving their working capital? They may be willing to accept a different form of payment compared to what you've used before. COVID has changed the entire payment strategy and the entire network dramatically. Explore different payment types, ACH and card. Vendors may be willing to accept cards now where they weren't before. Payables automation offers several benefits, including benefits beyond just maximizing your own working capital. Automated tools often include supported vendor enrollment for card and ACH, as well as data management. They may help you achieve extended terms. They may also help you not only optimize your internal processes, no more cutting checks and stuffing envelopes, but they may pay a rebate if a high enough level of card spend is also achieved. ACH payments can be done via online banking with a template or an upload from your ERP system. Remittance information may need to be provided via email as well. Commercial cards have many benefits. There are virtual card options, ghost cards, and other solutions that can help your business. Bremer recently rolled out our own commercial card program. This streamlined solution combines purchasing and corporate card programs to help you control spending and unlock purchasing flexibility. Integrated Payables brings all of these payments together. We will look at how this works more in depth, and then I'll share another example of how that benefited another client. The payables process without integration is very complicated, with many systems and many ways to provide remittance information. While this allows for vendor preference, it requires a lot of system maintenance. This is a typical representation of how businesses are working in an environment with multiple different payment options. On the next slide, you'll see this is how integrated payables works. You'll notice it's simplified with just one file, and it still allows for vendor preference. Your financial provider works with you on the creation of the payment file. Our system accepts files in many different formats, so it works across many different ERP systems. We start with a handful of required elements and work to see what your system can produce. It's a solution that allows you to maximize working capital and become efficient in your process by taking the busy work, such as cutting checks and stuffing envelopes, away from your staff. You'll also be supported by our team through the vendor enrollment and implementation process. As for a customer success story, we had a recent food manufacturer that began utilizing integrated payables in March of last year. In the first year, they processed 6,236 payments for just over $101 million. They had been trying to manage that with a staff of only 2 people. Within those payments, they processed $4.6 million in card payments with an average file turn of 23 days. They've been able to reduce what they borrowed on the line of credit by that amount. And when you think of that with today's interest rates, they have saved over $20,000 in interest expense.
Thanks, Brent. That's another great example. So to recap, we talked about what working capital is, why it matters to your business, and some bank tools that'll help you become more efficient. This is all really an approach to continuous improvement, which ultimately starts with knowing where you've been, where you are, and where you want to be. So figure out what bottlenecks and challenges exist and eliminate them. So once you've established your plan, document it, share it with your key stakeholders, measure your outcomes, and celebrate success. At Bremer, we're ready to help assist you in the process. So now we'd love to know what questions you have for us. I'm going to turn it back over to Jim. Jim, do we have any questions?
Thanks so much, Julie and Brent. And yes, we do have a couple. Brent, coming over to you. If I'm a CFO or a finance director on today's call and impressed with the ideas that you and Julie shared, but it seems a little overwhelming. Where do I begin? I want to do this, but where do I start? In your experience working with our clients, how does a finance director step into this? Understand there's a lot of change management process changes that are involved. I know where I want to get to, but how do I get started?
Yeah, great question, Jim. So I think the biggest thing is to work with your treasury consultant like myself and your banker, right? We've set up a lot of different scenarios for clients. And one thing I've learned over the years is that everybody's in a different phase of what they want to accomplish. By that, I mean, there's some clients that want to double in size within 3 years. Some want to triple in size in 5 years. What does that mean for the AR or the AP team? Is that double or triple the amount of payments? You may only have 25, 50 payments or checks coming in per month today, but that doesn't mean that there's not a benefit to our clients to implement those services sooner rather than later. And I think we find clients in a lot of different areas of those stages to say, hey, we want to implement something on the front end, right? We want to get in front of the volume increase and the explosive growth that we're planning for, or maybe they just want to sustain and they're going to have sustained growth, I would say, for the next 5 years. Either way, that really should be a discussion with your relationship manager and your treasury consultant to figure out a cost benefit analysis, the implementation process, what other priorities and other items are you guys working on, and what level of involvement does it take from myself or our implementation team to get you where you want to go as well.
Thanks, Brent. Julie, coming over to you based upon your accounting background and then also your banking experience. As you look at this body of work of efficiency, you use the phrase there's an element of change management. Any thoughts or advice or counsel in your experience about how you've seen a leader of an organization move through this change management in a healthy way, or maybe a not so healthy of a way?
Yeah, well, let's talk about the healthy way. The best approach is to involve your teams at all levels as early as possible. They're on the front line. They understand the day-to-day. They're usually the first to identify the best opportunities for improvement, and then having them be part of the solution, part of developing those, or identifying those problems and coming up with the solutions really does naturally lend itself to accepting change management. There's everybody's comfortable with what we're doing today. I mean, that's kind of a human nature element that you deal with. But getting buy-in early is essential. And I think having when we talk about continuous improvement mindset, manufacturers are really great at understanding this. Truly all rowing in the same direction. Everybody in the organization approaching it from the same perspective with the same goal in mind, being really fixed to your goal and flexible in how you get there, I think is a great way to approach these kinds of projects.
Awesome. Thanks, Julie. Love focusing on the positive. Brett, coming back over to you, one thing we talk about in our world today as we are looking at adopting technology and new processes is how do we mitigate risk? I want to get the value capture, but I also don't want to take undue risk. So when it comes both on the AP and the AR side of our solutions and the strategy, I want to use these, but I don't want to own my client's data. I don't want to own or my trade partner's information, or I want to reduce risk. But this is the unknown is the risk for me. Can you talk a little bit about conversations you've had with clients and prospects about risk, overcoming risk, and understanding the risk in these different types of solutions?
Yeah, that's another great point, Jim, because I think right now in my career, fraud and risk management seems to be as strong and as important of a topic as it's ever been, right? And owning your vendor's data, right? Routing numbers, account numbers. That's a sensitive topic and a sensitive subject. Everybody's in a different life cycle, I would say, and we do have tools that help basically remove that ownership of that data where it can be vendor managed, it can be vendor maintained. That's a huge aspect of it. The uncertainty around the Postal Service has changed that dramatically as well too, right? I think that's where more electronic payments are really being driven. We go back to COVID almost 5 years ago now, 4.5 years ago at this point, and I personally thought that that would be a huge driver for automation and electronic payments. It was to an extent, and it certainly helped. But I think if you look back over the last 4 or 5 years, risk management and fraud management has been an even larger driver, right? Not having to send checks out in the mail and not knowing where those are going. At some point, they're being manipulated, they're being intercepted, they're being changed along various means. And then ACH payments just have a lot more, I'm going to say, reliability with them, but you can also maintain that information in a secure way in making sure that you're verifying vendor change information, right? You're calling vendors that are requesting for bank change information or imposter fraud type of scenarios. So it's really a matter of being very diligent, no matter the form of payment, across check, ACH, even commercial card type of payments. It's just making sure that you have a set policy and you have your diligence in place to maintain all different forms of payments and the vendor requests and changes that come with those as well.
Awesome. Thanks, Brent. Josh, coming over to you. So here I am, the CFO or the finance director. I've adopted positive change management with Julie with some great tools and solutions that Brent has illuminated. And now I've got some excess working capital. As I look at the investment strategies, given the economic environment that you've kind of illustrated for us today, what do I do? Where do I go? What should I be thinking about going forward?
Come to Bremer. Well, the longer answer is it really depends on the liquidity, right? So if it is excess, yet you will possibly need it in the next 6 months or 1 year, that's obviously going to limit the options for how you would invest. If this is going to be set aside, then there's the other options. But again, with cash rates, overnight rates, money market funds, savings accounts, paying in a lot of cases more than what you can get by buying, say, a 6-month treasury, it really creates a conundrum, because if cash rates are going to fall, like, do I keep it in cash and hope that it stays higher than the overall blended rate I'd get for 6 months, knowing that markets look forward, so that 6-month rate is somewhat of a prediction of where rates will head. So liquidity management is really an important part of this, right? Like, it's not just getting the working capital and having excess, but what do you do with that? And thinking through money market funds or treasuries or other ways to manage that excess. And if that excess is permanent, thinking about ladder type strategies, buying bonds that mature at frequent intervals. So you have the liquidity, but also can go out a little bit further on the curve. Those are all important things to consider. It also depends on your, overall balance sheet. Like, how much borrowing do you have in general, and at what rate, and how do you think through the balance of maintaining extra liquidity versus paying down debt or investing in new projects? It's the challenge that every CFO faces. I, in general, right now favor, some of those shorter term instruments, though, as the yield curve does continue to rise. I think we're about 420 now on the 10-year. There are some attractive opportunities a little bit further out the curve for those who can take some investment risk.
Thanks, Josh. Coming back over to Brent and Julie, and I'll defer to either of you on this question, but the topic of ERPs, Enterprise Resource Planning Systems. I think that's the most common topic that when we talk about on treasury management, everybody's talking about. We're either upgrading it, RFPing it, selecting it, moving to the cloud. Something's moving always in that ERP. And a lot of the ideas and strategies, Brent, that we heard from you today, that's the core system that's going to integrate with a banking partner like Bremer Bank. So if I'm the CFO and the finance director, and I know I got an ERP upgrade, enhancement, moving to the cloud piece, but I also want to capture working capital, how do I balance those two priorities? Can I dual track it? Do I have to go one or the other? Any advice or counsel that you've had with your clients in that regard?
Yeah, absolutely. Julie, I can maybe answer first. One thing that I always offer to clients that are looking at that is involve your relationship team at your bank early on, right? If there's something we can provide to, whether it's your IT staff that's managing that upgrade or that ERP change, or you're using a third party, we should be having a discussion around what does it look like from Bremer's side and what can we do, right? Is it an integrated payable service? Is it another reconciliation service that we can provide integrated receivables? It's better to know that on the front end as you're going through that upgrade or that change, and to work with either your IT staff or that third party to vet out what that would require from their side to implement that type of service as well. A lot of times the answer is usually let's get through the ERP change and the conversion, but I think a discussion on the front end is absolutely warranted, and just making sure that we have all of the right things in the scope of work for that project and for that upgrade as well. So from our side, it really shouldn't be more than an hour or two discussion, and really to help vet out file formats and everything with either IT or third party, and just go from there. You know, those are the ones that are going to make it a smoother transition and a much more successful transition to not just the service, but to your accounting system or your ERP upgrade as well too.
Thanks, Brent. Yeah, and as it relates to optimizing your working capital and how your ERP upgrade might spring you to action on integrating with your bank, we've got kind of a continuum of ways that we can get data to you. Today, we see that the lion's share of our customers are still processing some or many or most of their transactions in some manual form or fashion. And the industry's evolving quickly, and Bremer's really on the front end of this evolution, this technology evolution. And we can, on the most technological end of that spectrum, we can for certain ERPs, we can integrate our customers straight into our system so they can access their data that's held in our system directly. So that would be a login through your ERP rather than coming in through our portal. And, you know, where that's really important for optimizing, you know, working capital or any continuous improvement work around your accounting systems and your processes and so on, is that information. So the more information you have, the better access you have to information, the more that the information is in the form and fashion that you need it to be, the more you can analyze your areas for opportunity and the quicker you can move on those. And integrating with your bank is really a much safer way to transact. And so there's a risk management component here that's really important too.
Thanks, Julie and Brent. Well, that brings us to the end of our submitted questions. So we'll go into a conclusion and wrap up. Once again, Julie, Brent, and Josh, thank you so much for sharing your insights and advice today. And thank you to all of you for joining the Bremer webinar. As I started the conversation today, our purpose is cultivating thriving communities, and we hope in this virtual community that we had today that you gain an idea or two that you can bring back to your organizations and your teams to try to continue your growth and thrive in this unique and dynamic economic environment. If something you learned or heard about today sparked interest, or you said, I want to learn more about that, please reach out to your Bremer relationship manager or treasury consultant. We'd be happy to bring in additional resources and ideas to go deeper and customize the conversation to where you are at. And as Julie mentioned, where do you want to get, and how can Bremer partner in that work elbow to elbow with you and your teams? With that, thank you again for your time today. We appreciate the conversation, and we look forward to having a future webinar audience. Thanks so much.